Well, good afternoon, everybody. It is 1:30 on the West Coast, so we're going to go ahead and get started. I'm Eric Patton, and I'm joined today by Stanley Barnes, who is a chartered financial analyst and a wealth manager here at Cutler. Thank you, Stanley, for being here. And this is our first quarter review and market outlook. And we're going to do things a little bit differently than we normally have, partly because of uh, the volatility that we've seen in the market and the news flow. We think it warrants a different approach to our presentation. So uh, bear with us. It's a little bit of a new format, but I think you'll enjoy it as we go along. There's a lot of interest in today's webinar, so thank you all for joining us. And with that, Stanley, let's jump right into it. Let me share my screen here. But we want to start with our disclosures and really talk about why we have these disclosures. New information becomes available all the time for market investors, and we really think it's important for us as your advisors to adjust our market outlook and our view of the economy as that new information becomes available. So while we might be saying things that are true today, given all of the information we have available, if our views change, or if the information changes, we do want to adjust our views accordingly. And this disclosure really says that in a nutshell. But today's agenda, we're going to start with the 2025 quarter in review. I mentioned things might look a little differently. We're only going to do one slide on our 2025 first quarter in review. And the reason for that is really, we all know on April 2nd, things changed in the stock market in a big way. I was very proud. We had our market commentary done on April 1st, ready to go. And then the morning of April 2nd, everything changed and we had to do a quick rewrite. But I think focusing on the future and really focusing on what you should be doing as an investor is an important part of today's presentation. So we'll move on to what has happened since the first quarter, our outlook from here. And then the last section is really about behavioral finance, which is a field of finance that's more psychological than it is economic. And I wanted to call this Cutler's Book Club, Investing Lessons from Ernest Shackleton. It's one of my favorite books, Endurance. I hope the analogy is okay, and bear with me on that, but I think the investment points that we'll be making in that analogy are going to be very worthwhile for you. So Stanley, let's jump into it. What happened in the first quarter this year?
Thank you for having me, Eric. So looking at the far right side of this chart, what you'll see is in 2023 and 2024, large cap growth stocks really led the way with positive returns. And it's really been a reversal so far year to date in 2025. Large cap growth stocks are down about 10% year to date, followed by US small cap stocks and mid cap stocks and large cap stocks overall. What's really done well so far is actually international stocks. International stocks up 7% year to date, emerging markets up 3%, followed by real estate bonds and large cap value stocks. So we've seen more or less a reversal of the last 2 years where international underperformed. Now it's outperforming and doing quite well, partially because of a weaker US dollar. Large cap growth stocks, specifically those large tech companies, the Magnificent Seven, have really gotten pretty beat up so far year to date.
And Stanley, I think it's important to note this is as of March 31st. Again, it's the first quarter numbers. And what jumps out to me is a few things. One, not everything is negative. But two, this was really an early part of a rotation. We've seen an acceleration of that rotation after April 2nd. So enough of the first quarter. Let's talk about everything else. What happened since April 2nd? Obviously, we know that was the day that the reciprocal tariffs were announced. And trade uncertainty. Trade uncertainty is at a record high. Uncertainty is not a word that Fortune 500 CEOs like. And so we have seen stocks react accordingly with stock market uncertainty. You can see here volatility of the S&P 500. U.S. stocks have been whiplash back to levels we haven't seen since the great financial crisis, the Great Recession. Even in 2020, when we had the pandemic, it looks on this chart that we're ever so slightly ahead of 2020 in terms of stock market volatility. And what that means for investors and for our clients is we think you really need to be careful when you're making changes to your portfolio, when you're trading in client portfolios. We saw a couple of days after April 2nd, stocks were down 4% in the morning. And then a tweet was released and it was circulated by Reuters that the reciprocal tariffs were all being postponed. Ultimately, that turned out to be true a few days later, but it was not true in the moment. It was actually a false tweet. But stocks whiplash, they went up 3%, a 7% swing in one day. A phenomenal amount of volatility that we've seen around this uncertainty. And we just want our clients to be very careful and very cognizant that when you're trading in those moments, you can get whipsawed very quickly by even erroneous information. Uh, so Stanley provided the numbers through March 31st. You can see the numbers are mostly similar in terms of the trends through, this is through Friday. And you can see international developed leading the way up 6%. US small cap stocks have been hurt the most at minus 16%. We'll talk about a few of the reasons why we think that might be true on the US small cap index. But again, bonds are up, international bonds are up. And then US large value down 4%. That's a big theme of our presentation here today, outperforming US large cap stocks and US growth stocks by a pretty significant margins. Stanley, really, as the first quarter, I guess, progressed and into the second quarter, we've also seen a big shift in economic activity. What are businesses and consumers doing? How are they responding? And this is the Atlanta Fed's real-time GDP estimate for the first quarter. What does this show us?
So in green, we have the real-time Atlanta Fed GDP now estimate, basically estimating what first quarter growth is expected to be. You saw a large drop at the end of February and a preceding drop April 2nd as well, when there were some tariff announcements. Really what has happened is businesses that import goods have started to accelerate their imports before the tariffs were put in place. They want to avoid those tariffs. They bought as much as they could as possible before the tariffs were in place to avoid some of the price increases there. And so you saw a lot of imports coming in, and imports are a net negative to GDP growth. Exports are a net positive. So when you have that big increase in imports, it does hurt growth for at least that quarter. Now, if we look at the blue chip consensus, that is the largest businesses in the US. That still had a negative trend, but instead of going from 2% down to negative 4%, as you saw in the green bar, this went from 2% down to about 0.5%. So still growth, but a lot less growth because of the tariffs and the acceleration in imports to avoid the tariffs.
Yeah, so this big drop is in many ways, it's kind of a math problem here that we're looking at. I think in terms of forecasting the economy, the important component here is how much of that inventory. So that big drop is an increase in inventory for businesses. How much of that are businesses able to move throughout the rest of this year and replace throughout the rest of this year? So have we front-loaded economic activity into the first quarter? We won't see this big drag from imports in Q2, but it'll be interesting to see what the consumers do and what businesses do throughout the rest of this year. What were they importing? Yes, gold was a big one. And you can see here, without this gold adjustment, even the GDP now, it's pretty much flat, not negative. But you look at our trade with China, which represents somewhere around 18% of U.S. imports. This is the distribution of U.S. imports from China by China share, and you can see for steel, household ware, and keyboards, nearly 100% of our imports come from China. For smartphones, gaming, and consoles, 80 to 90%. That's largely why we think we got an exemption for electronics being imported from China. Apple, the day before, the weekend before the tariffs were announced, they loaded up 5 aircraft full of iPhones and imported that, trying to get ahead of the tariffs and kind of get those onshored before those tariffs were inputted. That's an advantage that a large company might have, right? Apple can afford to really load up those airplanes and ship it over. Small businesses, the logistics are a little bit trickier. And that might be why we're seeing some of those small cap indexes underperform large cap, because perhaps their supply chains are more complicated to really divert or identify new suppliers from. But in an environment like today, there's a lot of advantages to large companies, and we think that that's a great place for investors to hide out during this market turmoil. All right, this next slide is noisy, and that's the point. There's a lot happening on this slide. We'll even make it noisier by scrolling along the left. The point is there's headlines everywhere, and investors can tend to get caught up in the noise and not necessarily think about where they're headed, or really what the long-term trajectory of the markets or of the economies are. And we're bombarded with headlines, and we want to really advise you to look past the headlines. Uh, we're not going to be in a trade war in perpetuity. This is the headlines are going to die down. Things are going to stabilize, and patient investors, we believe, will be rewarded for looking through the noise, looking past the noise, and for focusing on their portfolio. Stanley, today's market, though, is it a correction or is it a bear market? Kind of where do things stand, and what's the traditional outlook? This next chart really shows how markets have done in similar environments.
So as of right now, the U.S. market is in correction territory. A correction is defined by a 10 to 20% pullback. And what you'll see is right here, the average frequency and recovery of corrections and bear markets. So on average, every 10 months, you'll have a 5 to 10% pullback, not out of the norm. It's part of a healthy market. Every 22 months on average, so close to 2 years, you'll have a 10 to 20% pullback. So a correction happens every year, 2 years maybe. It's not out of the norm at all. Now, a bear market is defined by a 20% plus pullback, and that on average happens every 56 months. So, roughly every 4 or 5 years. Not as common. We did have one back in 2022. Right now, we're in correction territory. The S&P 500 did barely dip over a 20% pullback at one point. It came back since then. Again, there's a lot of volatility going on, but currently we are in correction territory. It's not guaranteed that we have a bear market. It could come back up, and it could be a bear market. It's still to be determined.
Yeah, and if it's not clear yet, one of our themes from today's presentation are that bear markets do happen, and as investors, we want you to be focused on your goals and working through those bear markets. But let's highlight, one of the reasons why today's bear market is happening, and it's related to S&P 500 concentration. Stanley, what's this chart show us here?
So on the left side, we have the starting absolute valuation, the S&P 500 forward 10-year annualized returns relative to the cyclically adjusted price to earnings ratio. So left side, you have -5% to 25%. That's the forward-looking return. On the bottom, you have the price to earnings ratio. And what you see is generally a downward trend. The higher the price to earnings ratio, the lower the average forward-looking returns. If you go over to the right side, looking at market concentration, this is looking at the largest stock relative to the 75th percentile stock in the S&P 500. And it really peaked out in 2023. You had the largest stock in the S&P 500 trading at 750 times the valuation of the 75th percentile stock. And so what it really shows is those large mega tech companies trade at very, very high valuations. And it's really defined by the concentration in the largest companies, specifically the Magnificent Seven and a couple other companies. And so what we've seen so far, 2023, 2024, those Mag 7 did extremely well. And now, so 2025 year to date, the Mag 7 have turned into what we call the Lag 7. So looking on the left side, the S&P 500, 2022 to 2024, averaged about a 9% return. That included the bear market. The S&P 500 tech sector, 16% nearly. So it almost doubled the S&P 500 overall. Now, flip-flop that around, quarter to date and year to date, the S&P 500 overall was down about 4.3%, whereas the tech sector of the S&P 500 was down about 13% nearly. So it's the tech sector really tends to be more volatile than the S&P 500 as a whole. When the market's up, the tech sector's up more than the market, but when the market's down, the tech sector tends to be down a lot more as well.
Yeah, and this is a little bit of a cheeky title, the Mag 7 to Lag 7. I do want to emphasize we're not advocating, especially in an asset allocation portfolio, to abandon the Magnificent Seven. Those seven stocks have really led the US markets higher for several years. They've been an important component of US outperformance relative to the rest of the world, and they're really an exceptional part of the US business environment. The Magnificent Seven, though, did get very rich in terms of valuation, perhaps overly invested, a very crowded trade, and that's reversed somewhat expectedly, but also there's been idiosyncratic reasons why each of the Magnificent Seven might have sold off. Not advocating buying or selling any of these, but I'm just going to read off the year-to-date performance through today of each of these. Microsoft is the best of the bunch, down 14%, Facebook down 19%, Google 21%, Apple 21%, Amazon 24%, Nvidia 30, and Tesla down 40%. You can see there's been a fairly significant pullback in these very widely owned, really the most widely owned US stocks. So the question is, if that's not working right now, and again, for long-term investors, we're not advocating to sell your large cap growth stocks into especially a bear market en masse. Maybe there's specific reasons for each investment that you might want to maintain an investment in. But what is working? In the next section is the case for international dividend stocks and bonds. We highlight this with the statement diversification is working. And we really want investors to understand that, especially in an asset allocation, you have a portfolio that's made up of different things than the S&P 500, and some of those are doing well right now. So Stanley, you're very passionate about international. I want to hand the baton to you and let you talk about international, why or how it's doing, and why you advocate international investing.
So when we look at the international equity market, it makes up about 37-ish% of the global equity market. The US makes up the other 63%. So far, in the last quarter, international has outperformed US stocks by 11%. This chart right here shows EFI, the international market outside the US, relative to the US market, and it shows what outperforms, underperforms on a quarter by quarter basis. You'll see on the far right side, that dark green right there, EFI has outperformed the US market by 11% so far in the last quarter. That is the largest performance discrepancy in the last 20 years for a single quarter. And you'll see, there are periods where the US outperforms international. And the main point we want to make here is that when you combine these two areas together, it really leads to a more diversified portfolio that really limits the volatility of your portfolio, so you get more smooth returns. On average, stocks across the world will go up, sometimes not all in line with one another. Sometimes international will do better, sometimes US will do better, and sometimes it'll be long spurts of one or the other doing better. We really want to smooth out those returns and get the long-term equity returns that we can. And so far, international year to date has done really, really well. Moving on to this slide right here, this is looking at the S&P 500 excluding Nvidia. That's in gray right there. And if you look at that and compare it to Japan and Europe, since October 2022, Japanese and European stocks have actually both outperformed the S&P 500 excluding Nvidia. Now, there is a little bit of cherry picking there. Granted that Nvidia has gone from about an $80 billion company to close to $3 trillion there. But the main point we want to make here is, Japanese stocks have done well, European stocks have done well. Over the last 2.5 years, having a global equity allocation has really generated positive returns.
Yeah, and one of the tailwinds for international stocks this year has been a weaker US dollar. We've seen a sell-off of the US dollar, but look at the longer term trend. Really, it bottomed in the financial crisis in 2008 on the left side of this chart here. And the dollar has been rallying for over a decade, and that really has been a headwind for international stocks for the last decade. And you've seen pretty significant US outperformance, both because of the stronger currency and because of the Magnificent Seven outperformance. We've seen already the Magnificent Seven has weakened this year. Similarly, we've had a weakening US dollar. That's a tailwind for international stocks. But Stanley, the argument that Cutler has made for international for several years hasn't been a currency related one. It's been a valuation related argument. And this next chart, walk us through what the valuation looks like of international equities still.
So historically, international equities have traded at a discount to US equities for a variety of reasons. But looking at the chart on the left, the 20-year average price to earnings ratio, the S&P 500 trades at around 16 times earnings historically. The ACWI ex-US, basically the non-US global equity market, trades at about 13 times earnings. So there's a small discrepancy in discount there for international stocks. Now, currently where we're at, the S&P 500 trades at about 20 times earnings. That's about a 25% premium to the historical standard for the S&P 500. ACWI ex-US trades at about 13.4 times earnings historically. So that's more or less in line with the historical relative valuation. If we look at the chart down below, what this shows is how many standard deviations away the European or the non-US discount was to US equities, and it got larger and larger and larger over time to the point where we actually got over 2 standard deviations away in discount, about a 38% discount, and now that's actually popped back up so far year to date. You'll see that little purple dot right there. there's been about a 7-8% decrease in the relative discount for non-US equities. If we move to the chart on the right, this shows that the relative valuations and discounts on a sector by sector basis. And again, historically, the 20-year average, non-US has had a bit of a discount in every area except for healthcare. Well, right now the discount is larger in every single sector except for the communication services sector, and it's also larger than the historical norm for 9 out of 10 sectors.
Yeah, so that explains a lot of the dynamics happening in international stocks. Uh, we mentioned before, dividend stocks are also working. We want to move on to talking about dividend stocks, and I will tell you, this next chart is my favorite chart in today's entire presentation. In 1977, Ken Cutler got started at Cutler managing a portfolio of dividend stocks. We call it our equity income strategy, and we still manage dividend stocks today. It has been a core component of our philosophy as a firm. And I think this next chart summarizes why. This is not Cutler numbers. This is a BlackRock chart. But you can see this is since 1978. Cutler started in 1977. So pretty much our corporate history talking about bull markets and bear markets of dividend stocks and non-dividend stocks. And I think this is just a phenomenal way of looking at the value of dividend stocks during volatile markets. On the far left, you can see in bull markets, dividend growers and initiators, that universe of stocks up 19.9% versus non-dividend payers up 24.3%. So yes, in bull markets, you've gotten, another 4.4% return than you would have gotten in a dividend portfolio. But look at bear markets. Look at that differential. And dividend stocks in bear markets historically have lost 11.7%, whereas non-dividend payers have lost 30.3%. That's just a huge discrepancy. During bear markets, investors often there's a flight to quality, a flight to safety. You see it in dividend stocks, you see it in bonds, which we'll talk about in the next section. But oftentimes those stable cash flows and those kind of larger companies with dependable cash flows and reliable dividends tend to attract capital during periods of uncertainty. This is a great place to hide out in today's market. And we're strong believers in having a piece of your portfolio or at least a piece of your portfolio in dividend stocks. Stanley, let's talk about a little bit dividend versus growth and kind of the year-to-date dynamic a little bit more in terms of what's happening more specifically this year.
So on the chart on the left side, we have year-to-date returns of value, blend, and growth, and then large cap, mid cap, and small cap stocks. And what you'll see is large cap value is actually up year-to-date, 2.1%. Large cap growth down about 10%. So again, those large tech companies have really gotten hurt. If you go down to mid cap and small cap, across the board, mid cap is value has outperformed growth. And again, larger has tended to outperform the smaller companies. Now, if we go to the middle chart, this is looking at since the market lows of October 2022, so right after the last bear market, it was a very large increase, a large upswing. 2023 and 2024 were great years. The last quarter of 2022 was great. Value underperformed growth. Large cap value was only returned 45%. Large cap growth returned 77%. Similar stories with mid cap, small cap, growth outperformed value. Well, if we look at since the market peak in 2022, this is before the bear market started, large cap value up 20%, large cap growth up 20.5%. That's more or less performing in line with each other through a full market cycle. And if we actually go down to mid cap and small cap, you'll see that value pretty heavily trounced growth. Mid cap value outperforming, 9.7% versus 5.6%. These are annualized numbers. Small cap negative 3.5% versus negative 11.6% for small cap growth. So the point here is that although value may not do as well during the growth times, because it avoids those large negatives relative to growth, value does have its day in the sun and it does tend to do pretty well, and it really smooths out the returns, whereas growth is very, very volatile and has large up and down swings.
Well, and it's not a perfect corollary here, but we are using large value to represent the dividend stock space. But obviously, there are large value companies that may not pay a dividend as well. All right, so what about valuations? This chart shows growth versus valuations. And given the strong performance of growth stocks over the last 4 or 5 years, or really the last decade, it's not surprising what you see on this chart. Let me walk you through it. The green line in the middle is the one to focus on. When the chart is above the green line, that means growth is cheap. When it's below the green line, that means value is cheap. And you've seen, with the exceptional run of growth stocks, that value got increasingly relatively cheaper versus growth. I think that's partly why we saw a rotation out of value into growth even before the tariff announcements in those uh, first quarter numbers. That investors were kind of taking some gains off the table, perhaps, and rotating to portions of the market that looked a little less expensive. All right, so what about bonds? Bonds have been really, well, I'll call it dead money for the last 5 years. In fact, in 2022, we saw the worst bond year ever when inflation spiked to 9%. Bonds sold off 13%. That's not what's supposed to happen with bonds. Stanley, are bonds working right now?
Over the last quarter, bonds have been doing actually pretty well. So on the left side, we have, as Eric mentioned, bonds sold off 13% in 2022. They've come back to a degree since then, all but with volatility. Cash, has pretty heavily outperformed. It doesn't have any downsides. You have the risk-free rate, so to speak. But again, you're going to get lower long-term returns relative to bonds, generally speaking. If you go to the chart on the right, we're really starting to see bonds do their job. Over this last quarter, bonds are up a little bit under 3% year to date. Cash has not done quite as well. Um, Bonds are supposed to be your steady piece of the portfolio that generates cash flows, not super volatile. So, bonds have really started to make a comeback. Right here, looking at interest rate expectations, this is the target rate probability for the Federal Reserve, how many cuts we're expecting over the next year, basically. If you go 1/3 of the way into the chart, you look at December 30th, 2024, that's the end of last year. We were expecting 2, maybe 3 rate cuts. Fast forward to where we are today with all the market volatility, the tariffs potentially coming in, a lot more economic uncertainty. We're expecting now, the market's expecting 4, 5, maybe even 6 rate cuts. So it's really accelerated the likelihood of more rate cuts. Instead of seeing a 50, maybe 75 basis point decrease in money market funds, we're now more likely to see a 1, maybe 1.5% decrease in money market funds from 4.2%. So it was going to maybe be down at 3.5%. We're looking likely that we're now going to be maybe at 3, maybe even below 3% for money market funds by the end of the year.
Yeah, and remember the Fed has a dual mandate. They're responsible for price stability, which is inflation, and they're responsible for full employment. And the way they achieve price stability is by keeping rates high, and the way they achieve full employment is by stimulating the economy and lowering rates. And an indication that the Fed is cutting rates is really that we have higher unemployment, that the recession risk has increased, and that the inflation risk is diminished. And so this is suggesting that the Fed will respond to the economy as it develops. The great news is at 4.25 right now, we have room for the Fed to support the economy. We have room for the Fed to cut rates should things continue to weaken. And that has historically stimulated economic activity, stimulated the stock market. And there's plenty of room for the Fed to operate, which we think is ultimately good as a good support for stocks. All right, so moving on to the behavioral finance portion of our presentation and what you should be doing, how you should be reacting, the way we want to advise our clients. And I wanted to preface this, I'm going to call it Cutler Book Club. I read the book. I don't know that our clients read it with me, but it was one of my favorite books, Endurance. This is a book that came out in the 1950s about Ernest Shackleton, who wanted a voyage to the South Pole. And everything went wrong. This picture of the Endurance, the name of his ship on the front, it really, the Endurance was crushed by ice. They had to abandon ship. It ultimately took 600 days for them to be saved or rescued. And it included an 800-mile open water voyage, a journey over the mountains. But ultimately what happened was all 27 members of the crew survived. And Ernest Shackleton has been praised for decades for his leadership and his really astute decision-making during a time of crisis. So during a time of crisis, how should investors be reacting? How should you be managing portfolios or monitoring your portfolio? during times like this. Let's take some lessons from Ernest Shackleton. So, lesson number one, he had a clear mission, make it to the South Pole, but he had a flexible path. The quote here on the page, difficulties are just things to overcome after all. And the investment lesson here is stick to your goals, but be flexible with your strategy. Stanley, let's talk about bear markets and maybe some ways you can be flexible with your strategy during a bear market.
So right here, we're looking at the S&P 500 bear markets, how much they dropped from their peak to their trough on the left side, and then on the right side, how long they lasted. So the biggest one, 1932, dropping 83%, took 26 months to go from the top to the bottom. What you'll see is as time has gone on, we've had some large drops. The financial crisis, 57% in '09, COVID, 34% in 2020, and then 2022, the most recent bear market, 25%. And generally speaking, the longest they've taken is under 3 years to go from the top to the bottom. Some of them have been very short. 2020 only took 1.1 months. But the main thing to think about is even in the grand scheme of things, bear markets, when the longest duration to go from the peak to the trough has been 2.5 years, and then things start rebounding, it really shows that markets go up over the long term. Yes, bear markets happen. Some can be short, some can be long. But when you're investing in the stock market, it's a long-term play. You're going to go through these ups and downs.
Yeah, it took the crew of the Endurance 600 days to be rescued. And you can see on this chart, the average bear market is much less than that. Some ways you can be flexible. Talk to your advisor. You've got some investments in your portfolio that we've talked about that are holding up relatively well in a bear market. Bonds, for example. And maybe during this down market, if you have cash flow needs, you should be using your bonds for those withdrawals, for your cash needs, giving your stocks time to recover, as markets historically have done. Another way to have a flexible path, if you have a taxable account, look for tax loss harvesting opportunities. Inevitably, in a bear market, there are going to be opportunities to realize losses. You can bank those losses and reduce your tax burden in the future. And then finally, a way to be flexible, in an asset allocation portfolio, yes, the S&P is down about 13% year to date, but most portfolios in an asset allocation mix are down much less. Why? Because of those pieces of the portfolio that are holding up better. Well, you still have time, and you can be afforded the flexibility to reassess your risk. Are you comfortable with where things sit today? Are you comfortable with the volatility in your portfolio, knowing your long-term goals? And small adjustments we do think is appropriate if you look at your portfolio and you're not comfortable with the level of risk. Let's reassess and make sure you're in a portfolio that makes sense for you. All right, so being flexible with your path is lesson number one. Lesson number two, stay calm in a crisis. When the Endurance was crushed by these ice sheets caving in the sides of this boat, Shackleton made bold but measured decisions. He set up camps, rationed supplies, timed the escape from the ship. Uh, Warren Buffett says, "Be calm when others are fearful." Stanley, how does the typical investor perform in terms of following the trends or following the tide?
So the typical investor who's going to make active decisions and not stay in their recommended allocation over the long term tends to underperform the market, unsurprisingly. Looking right here at this chart on the top right, we have the average equity fund investor in orange. Over the last 30 years, they've gotten about 8%, while the S&P 500 has done a little bit over 10%. So the average equity investor has underperformed by 2%, specifically because they tend to go to cash when the market goes down and miss the upswing. That's one of the most common reasons. And really, they're missing out on performance. If you're invested in stocks, you're doing it for the long term. You're not trying to time the market. You're invested for that long-term equity rated return, that equity risk premium. You want to get the return from that. Going down to the growth of $100,000, the chart below, this shows over the last 30 years how $100,000 would have grown. Again, the average equity fund investor turned $100,000 into 1.01 million, 10 times their money. That's not bad over 30 years, but the S&P 500 has nearly doubled that, turning 100,000 into 1.82 million. Again, you're leaving money on the table if you're not staying invested in your recommended allocation. Do not make active decisions to get out of the market. If you're in the market, you're in it through the ups and downs. and you're really going to get that long-term equity rate of return. The best time to get into the market is in the depths of the crisis when there's so much bad news, and that's already being priced in.
Yeah, and this is 30 years of data, Stanley. And to me, what jumps out is really that long-term value for investors for being in the stock market. This next chart shows it in a different way here. The red line is the actual S&P performance. The blue line is investor sentiment, and you can see investors are all over the place. Sometimes we're excited, sometimes we're, in the dumps. But you can see the long-term trend for the stock market doesn't care about your feelings. So we like to advocate for stocks uh, because of really what this red line is saying, and we want our clients to focus on that long-term value for the stock market. That kind of leads us to the third point of Shackleton here: endurance and patience. He actually named his boat the Endurance. The crew survived for 600 days, stranded in the Antarctic. They didn't have a lot of the equipment that we'd have today. This was over 100 years ago. They have frostbite, hunger, near madness. The relevance to investing, long bear markets or economic downturns, they test your endurance. And I think this is a great line here. The investor lesson: patience is not passive, it is an active discipline. If you are doing nothing during a bear market, you are making an active decision to hold fast, to ride out the volatility, and to stay focused on the eventual recovery. That's the advice we want to give our clients, regardless of the market conditions. That patience is rewarded in the stock market. Stanley, let's look at a couple of charts talking about how that patience is rewarded in the short and medium and long term.
So in yellow for each time period, we have that's the chance that the market's down over that given time period. Orange is if it's up. So 1 month on average, 63% of the time the market's up, 37% it's down. Fast forward to a year, it's about a 75-25% split. 5 years, closer to 90-10. Go out 10 years, 95% of the time the market's up. Really, the point here is the longer and longer your time horizon, the higher and higher the chances are that the market goes up over the long term. When you're investing in the equity market, you're investing in businesses. Businesses exist to produce products, services. They produce a profit. Long term, they will grow their product line, they'll grow their business, they'll produce profits. Dividends will get reinvested as well. And so, generally speaking, the longer your time horizon, the longer your equity or the higher your equity allocation, the higher the chance the market will go up over that time period.
Yeah, and one last chart to kind of hammer that point home. This is about market timing and investors trying to get the bottom exactly correct. And the price of the S&P typically bottoms on average 9 months before the earnings per share of the S&P bottom. So this chart really it shows that data. The S&P on the left in red, the market lows are right there, set at 0 days. 200 trading days later, S&P 500 earnings bottom. So the market is a forecasting mechanism. It really is looking ahead at not what's going to happen in the next week or two, but what's going to happen in the next 6 months or 12 months or 3 years. Uh, and we want to also maintain that same mindset, that long-term mindset of, okay, I'm investing for my retirement, or I'm investing for next year, or I'm investing for a legacy. What are those long-term goals, and how should I be looking at the market given those long-term goals? All right, so how can Cutler help you with this year? We've talked a lot about the markets, the economy, the investing. There are a lot of financial planning topics that also can add value to your situation. Anything on this page, please feel free to reach out to your Cutler advisor and talk about, because we all make a lot of decisions every day that impact our finances beyond just the stock market and what's in our portfolio. So if you do have any questions, please feel free to contact Cutler about these. And again, thank you for being a Cutler client. Thank you for the interest in today's webinar. We really appreciate you taking the time to understand how we are looking at the stock market, how we look at the economy, and we hope that that gives you some confidence as you move forward.